Fintech has evolved. What began as a nascent industry in the early 2000s has transformed into a powerful force reshaping the global financial landscape. The fintech hype first arose in 2010 when innovative companies began leveraging technology to offer financial services in new and efficient ways. This era saw the rise of digital payment platforms, mobile banking, and online lending, which promised to disrupt traditional banking models and democratize financial services. Over the next few years, the fintech industry experienced rapid growth and diversification. Startups like Square, founded in 2009, enabled small businesses to accept credit card payments via mobile devices, while peer-to-peer payment services like Venmo and M-Pesa revolutionized the way individuals transferred money. Fintech was initially touted as the great disruptor of banks, challenging their long-standing dominance and forcing them to innovate or risk obsolescence. The COVID-19 pandemic in 2020 further accelerated fintech adoption. As lockdowns forced consumers and businesses to shift to digital channels, the demand for contactless payments, online banking, and digital investment platforms surged. This period marked a significant turning point as fintech became integral to everyday financial transactions and management. However, the rapid expansion and excitement around fintech led to what many termed the fintech bubble. Venture capital funding soared and the number of fintech startups proliferated. By 2021, fintech investments reached record highs, with companies raising billions to scale their operations and capture market share. Despite this exuberance, 2022 brought a reality check. A market correction dubbed the fintech winter saw valuations drop, funding slow, and many startups struggling to sustain their growth. This period forced fintech companies to pivot from aggressive expansion to focus on sustainable, profitable growth. Banks in turn seized the opportunity to develop their own fintech-inspired digital products and services, intensifying the competition. All these developments have led us to 2024, a year where fintech continues to thrive, but with a more mature and balanced approach. The industry has weathered its cycles of hype and correction, emerging stronger and more resilient. Fintech companies are now better positioned to innovate and collaborate with traditional financial institutions, driving forward a new era of financial technology that promises to benefit consumers and businesses alike. So in this video, I'm going to speak about what fintech is in 2024. I'll explore a brilliant article by McKinsey that paints a vivid picture of what the essence of fintech is in 2024. We'll cover the global fintech trends, technologies propelling fintech forward, strategies fintech companies have adopted in order to thrive, the shift towards open banking, how fintech is transforming the financial landscape in Africa, Europe, and the Middle East, and then chat about what's next for fintech and how traditional financial institutions can adapt and compete. This is going to be a much longer video than my usual, so if this captures your interest, then buckle up and let's chat about it. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so because on this channel I speak about fintech, digital transformation, and agile strategy. These days, living in the developed world, you're almost more likely to see the inside of a bank branch in an old movie than you are in real life. But take a look at your phone. There are probably at least 2 money apps on your home screen, maybe more. According to McKinsey's research, this is just one sign of a new era in payments. What's one major development behind this shift? The short word yet big concept is fintech. Now, fintechs, which is short for financial technology, are companies that rely primarily on technology to conduct fundamental functions provided by financial services, which affects how users store, save, borrow, invest, move, pay, and protect money. Most fintechs were launched after 2000, have raised funding since 2010, and have not yet reached maturity. They make it not only possible but also easy to move money between accounts, people, countries, and organizations. There's no typical fintech company. Fintechs include startups, growth companies, banks, non-bank financial institutions, and even cross-sector firms. Examples range from peer-to-peer payment services like M-Pesa, Venmo, or Zelle to automated portfolio managers and stock or cryptocurrency trading apps like Robinhood and Coinbase. Fintech came into prominence around 2010, primarily in the payment space. Square, for instance, which was founded in 2009, enabled small companies or sellers to accept credit cards via a mobile device. Today, fintech disruptions have expanded to every corner of finance, even areas once assumed to be safe from digital threats. Fintech is spreading fast, In the United States, for example, almost 1 in 2 consumers in 2021 used a fintech product, primarily peer-to-peer payment products and non-bank money transfers. Fintechs also raised record capital in the second half of the 2010s because venture capital funding grew from $19.4 billion in 2015 to $33.3 billion in 2020. But recently, the luster has worn off a bit. In 2022, a market correction caused a slowdown in fintech's explosive growth and momentum. As a result, fintechs have had to adjust to lower valuations and decreased willingness on the part of venture capital firms to fund companies with low margin. Rather than sprinting towards the hockey stick of old, fintechs today are focused on sustainable, profitable growth. Banks, in response, have seized the opportunity, developing their own fintech-informed digital products and services. In the future, competition for client deposits and balances will likely intensify. But before we look into the future, let's first explore the past and present. Now let's focus on where is the banking industry in its digitization journey. Banking is in its second era of digitization. Now, according to McKinsey senior partner Brian Ledbetter, traditionally banks were anchored on a customer service arrangement that relied on branches and call centers. He says if you needed something, you either ring on the phone or you go into the bank branch and it would get done. Then with the advent of smartphones, we discovered that mobile and digital technology was the primary way to engage with customers, and so we had a boom in apps and automated journeys which banks hooked up to their existing systems. Now this has led to a problem of technical debt. When banks set up the first phase of digitization, they did so with the technology they had at the time. Over time, these older systems have become obsolete. This created an opportunity for more agile fintech companies to disrupt business as usual, offering customers less clunky, more convenient ways of doing business. Today, banks are at an upgrade point for both the front and back ends, and their institutional capacity may be a benefit when it comes to adopting and deploying solutions based on rapidly advancing new technologies. Now, which 3 themes will shape the next chapter of fintech growth? According to McKinsey's research, the 3 trends that will shape the next phase of fintech growth are firstly, that fintechs will continue to benefit from the radical digital transformation of the banking industry and e-commerce growth around the world, particularly in developing countries. About 73% of the world's interactions with banks now take place through digital channels. B2B firms are also demanding more fintech solutions than ever. To capitalize on the demand, fintechs will need to keep up with evolving regulations and ensure that they have adequate resources to comply. Secondly, despite short-term pressures, fintechs still have the room to achieve further growth in an expanding financial services ecosystem. McKinsey estimates that fintechs will grow at roughly 3 times the overall banking industry's growth rate between 2022 and 2028. Emerging markets will fuel much of this growth, particularly in Africa, Asia Pacific, excluding China, Latin America, and the Middle East. Finally, some fintechs are proving more resilient during the current market correction than others. Companies in the growth stage, Series C and beyond, showed the highest sensitivity to the 2022's downturn. Fintechs in the early and pre-seed stages were more resilient. Funding for B2B fintechs was more resilient than that for B2C ones, and banking as a service, embedded finance, small and medium-sized enterprises, and corporate value-added services were the verticals least affected by the downturn. So which technologies are shaping the future of fintech? Over the next few years, McKinsey predicts that the following 7 technologies will advance fintech development while shaping the competitive landscape of finance. AI is obviously the first one. Artificial intelligence will propel massive value creation. Banks and other financial institutions are poised to adopt an AI-first mindset that will better prepare them to fend off expanding technology firms. McKinsey estimates that generative AI technologies alone may add up to $4.4 trillion annually to the global economy. Second is blockchain. Blockchain will disrupt established financial protocols by allowing the storage of financial transactions in multiple places at once. Technologies such as smart contracts, zero-knowledge proof, which is a way of proving you have a piece of information without revealing what the information is, and distributed data storage and exchange, which is essential to existing fintech innovations such as digital wallets, digital assets, decentralized finance, and non-fungible tokens, will continue to play a prominent role. Third is cloud computing. McKinsey research indicates that by 2030, cloud technology will account for EBITDA in excess of $1 trillion across the world's top 500 companies. For financial services companies, cloud computing will increase efficiency and lower costs. The Internet of Things, IoT, is fourth. Now, IoT applications for the finance industry include perception and smart sensor systems, wireless communication networks, and application and operations support. Next are open source software, serverless architecture, and software as a service. Now, these three technologies have become must-haves for technology companies and traditional financial institutions launching new fintech businesses. They enable increased speed and scalability, both critical for new businesses competing in a winner-takes-all digital economy. Then we have no and low-code development platforms. Now, these allow programmers and general users to develop applications through graphical user interfaces and configurations such as drag and drop instead of traditional computer programming. Finally, we have hyper-automation. Now, hyper-automation is the use of AI, deep learning, and events-based software and other technologies and tools to improve decision-making efficiency and work automation. Now, how can fintechs shift towards sustainable growth? Fintechs today are operating in a new environment. They can no longer afford to focus on growth at any cost. Given new liquidity constraints, fintechs are emphasizing profitability, not just growth in customer adoption numbers or in total revenues. In 2019, McKinsey conducted a study of the growth patterns and performance of the world's 5,000 largest public companies over the preceding 15 years. Now, based on their analysis, they expect 4 pathways to deliver the most impact for fintech. Number 1 is cost discipline. Controlling costs to withstand the new funding environment while remaining flexible, nimble, and compliant. Number 2 is measured growth based on a stable core. This is ensuring there is a strong and stable core business with a targeted and proven market fit before expanding. Third is programmatic M&A. Pursuing mergers and acquisitions strategically and establishing mutually beneficial partnerships based on programmatic strategy rooted in value sharing with incumbents and other fintechs. And lastly is keeping the culture alive, maintaining the agility, innovation, and culture that have propelled disruption thus far. Now, what is open financial data? The financial data is pretty self-explanatory. It's records of what we spend, save, and borrow, from mortgage payments to what we've paid for this morning's coffee or latte. In the past, banks have been keepers of our financial data, and the idea of sharing it with anyone probably made them a little bit uncomfortable. Now, some of that data is being shared with third parties. This is a trend called open financial data or open banking. Now, let's make one thing clear. None of this happens without consumer consent. But when consumers do consent, they allow a new and growing set of actors, both financial and non-financial, to access their accounts and data to offer new products and services based on what they might need. This movement is still in its infancy, but has big potential to reshape our bank accounts, credit and debit cards, payments, mortgages, loans, and even insurance policies. The adoption of new digital banking habits, in part as a result of fintech disruptions, appears to have accelerated open banking. Now, what can incumbents do to prevent disruption from fintechs? Fintechs have successfully highlighted existing financial institutions' weaknesses in digital user experiences as well as in operational efficiency. It almost doesn't matter how much market share fintechs take from incumbents when they have so successfully recast customer expectations. At this point, it's imperative for incumbents to transform to meet the new reality informed by fintechs. Here are 7 options for incumbents to consider. First is to buy a fintech, whether it's for traction, technology, or talent, but success depends on post-acquisition integration. Second is to partner with a fintech to induce faster time to market and cost-efficient implementation. The third will be to invest in fintechs to hedge against some of the potential threats of disruption. Or incumbents can transform to become more like a fintech. Transformation is necessary to compete with outside threats, fintech or otherwise. Incumbents can also build an internal fintech. Increasingly, incumbents are building their own internal fintechs to self-disrupt areas of their business before others can disrupt them. Next would be to serve the fintechs. A few financial institutions might find competitive advantage in banking as a service, serving fintechs as well as retailers, telcos, and many more. And finally, ignoring the fintechs. Now, ignoring competition is rarely the right choice, but some incumbents are built behind regulatory moats that are difficult to disrupt. So regulatory protection gives them the confidence to just ignore these so-called disruptors. Now, the right answer is probably a combination of the above, implemented after careful planning. My personal preferred recommendation is to partner with a fintech to induce faster time to market and invest in fintechs to hedge against some of the potential threats of disruption. Now, let's move on to how fintech is changing the financial landscape of Africa. Kenya has one of the highest levels of fintech penetration in the world, propelled largely by the explosive success of one fintech, M-Pesa. Now, M-Pesa was launched in 2007 and has made it easier for Kenyans and later on people in other countries to use mobile phones to reliably and quickly pay one another. It was quickly adopted by most Kenyans. Now, between 2020 and 2021, the number of tech startups in Africa tripled to about 5,200 companies, and just under half of these are fintechs. Cash is used in about 90% of transactions in Africa, which means there is huge room for growth. If the sector overall can reach similar levels of penetration to those seen in Kenya, McKinsey has estimated that African fintech revenues could reach 8 times their 2022 value by 2025. Now, looking ahead, it's anticipated that the growth opportunity in African fintech will likely be concentrated in 11 key markets, namely Cameroon, Cote d'Ivoire, Egypt, Ghana, Kenya, Morocco, Nigeria, Senegal, Tanzania, Uganda, and South Africa, which is home to the continent's most mature banking system. Together, these markets account for 70% of Africa's GDP and half its population. However, there are some challenges that emerging African fintechs may face. The first is reaching scale and profitability. The total addressable market, which is the number of viable customers for African fintechs, may be limited by infrastructure constraints, including weak mobile and internet penetration, lack of internet coverage, and limited payment rails, which is the underlying infrastructure that facilitates transactions. Lower disposable income and lower customer loyalty may also make it harder for fintechs to scale. Second is navigating an uncertain regulatory environment. Different countries evolve regulations at different paces. Generally, complex and variable regulations make it difficult for fintechs to ensure business continuity and compliance across markets. The third will be managing scarcity. Funding is slowing down for African fintechs after a record-breaking 2021. But fintechs can't afford to slow down their progress, especially as incumbents begin catching up. This suggests African fintechs will have to tighten their belt and adjust to a new venture funding reality. The fourth will be building robust corporate governance foundations. In a regulatory, socio-economic, and political environment that can be uncertain and fragmented, a strong corporate governance structure can provide stability, clarity, and direction, especially in times of difficulty. Strong corporate governance includes strong culture building, productive stakeholder engagement, and a clear talent strategy to build the organization's capabilities. Now, the path ahead isn't expected to be smooth, but if stakeholders can work together to build on the momentum of recent years, the prospects for African fintechs are tremendous. Now, what about the state of fintech in Europe? Fintech in Europe was hit hard by COVID-19 and the resulting economic uncertainty. But in the long term, fintechs continue to gain strength and relevance for customers and the economy. In each of the 7 largest European economies, as measured by GDP, at least one fintech ranks amongst the top 5 banking institutions. But fintech has not progressed in each European market at the same speed. There's a wide divergence of maturity and performance among countries, with a substantial gap between the top 1/3 and the rest. 2 countries in particular stand out for their superior fintech ecosystem performance: Sweden and the United Kingdom. If fintech ecosystems in all European countries were to perform as well as the best in the region, the upside would be substantial. The number of fintech jobs would grow to more than 364,000. The volume of funding would more than double to almost 150 billion euros, and valuations would balloon to almost 1 trillion euros. Now, here are the ways in which fintechs can benefit European stakeholders. 1. The appeal of fintechs to European customers is that they offer superior service at lower cost. International transfers, for example, can cost just 10% of the rates charged by traditional banking service institutions. 2. Fintechs are a catalyst for disruptive innovation and growth in the financial ecosystem as a whole. They are typically more agile and quicker than incumbents, which means they are able to launch new products and services much faster. For example, the average time to market for fintechs is as little as 2 months compared to 12 months for incumbents. 3. Fintechs are an important source of potential growth for the overall economy. As of 2022, fintechs have created approximately 134,000 jobs across Europe and represent a total valuation of almost 430 billion euros. That's more than the combined market capitalization of Europe's 7 largest listed banks. For the European financial system to achieve the potential made possible by fintech, stakeholders such as public institutions, incumbents, and fintech upstarts will need to combine their strengths by setting up appropriate enabling structures and mechanisms. Now, let's move to the future of fintech in the Middle East, North Africa, and Pakistan. The fintech has boomed in the MENAP region in recent years. Investor backing increased by about 36% annually from 2017 to 2022. Here are 5 types of fintech companies in the MENAP region. Number 1 are homegrown fintech startups. So local fintech startups are addressing not only payments, lending, insurtech, and investments, but also additional consumer and business needs such as home buying, payment apps and wallets, and merchant payment solutions. Second are international fintech firms. So established international fintech firms have launched in the MENAP region, stimulating competition and helping promote customer adoption. The third are banks. Leading banking incumbents have moved quickly to offer digital-only offerings. These include Weye Bank, which is a digital youth-oriented bank by National Bank of Kuwait, and Live, a digital lifestyle banking app from the Emirates National Bank of Dubai, and a number of others. Now, other non-banking financial institutions, so these are established payment processors, exchanges, remittance services, and other traditional infrastructure providers who have launched mobile apps and digital portals. In some cases, they have partnered with some fintech startups. Then we have the cross-sector fintech firms. Now, these are large companies with leading market share, especially in telecommunications, which have progressed from mobile cash to broader offerings such as mobile wallets, mobile payments, and branchless banking services. Now, while 2022 brought with it a global drop in fintech valuations, it's believed that the market in the MENAP region is likely to continue growing. By 2025, it's estimated that the fintech revenue in the MENAP region could be up to $4.5 billion. Now, realizing this potential is another story. For fintechs to continue to expand their roles in the daily lives of consumers and businesses in the MENAP region, they'll need to invest capital, work with regulators, and cultivate talent and partnerships. The shape of the fintech industry has dramatically changed over the years. From its disruptive beginnings to its accelerated adoption during the pandemic, and through the cycles of boom and correction, fintech has evolved into a more mature and integral part of the financial ecosystem. Despite the shifts, the prospects for fintech remain incredibly promising, especially in regions like Africa, where the potential for financial inclusion and economic growth is vast. To capitalize on these opportunities, fintech companies will need to focus on sustainable growth strategies, navigate complex regulatory environments, and build strong partnerships with traditional financial institutions. Additionally, continued investment in innovative technologies and robust corporate governance will be key to thriving in this dynamic landscape. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment. I'll leave the link to the full McKinsey article in the description. Have an amazing week, and I'll see you in the next video. Cheers, guys.